In Switzerland, the real estate market is very different from region to region and from city to city. Of course, Geneva is very expensive. It's the most expensive in Switzerland. After that, Zurich is also, of course, expensive. But on the other side, even Zurich is expensive. There is a lot of money in Zurich. There is a lot of local money. And this local money is cash. And this money want to be invested. So you have also the pension funds, they need yield. You have the insurance company, they need yield. And all these groups, they buy. And Switzerland is like a safe haven, political safe haven for a lot of people from Europe, but also from abroad. You have Russian, you have Chinese, they move to Switzerland. You have some French, you have Americans, they move to Switzerland and take Swiss nationality. And all these people, they want to live somewhere. That means you have a high quality real estate market, and you have a very high purchase power in Switzerland. That means you have here in Switzerland a lot of people, they could buy if they would like to buy, but sometimes they don't buy because it's not in the habit. You have in Switzerland only less than 40% owner. Less than 40% owner in Switzerland compared to countries like Spain with 80% owner, or France with 75% owner, or Italy with more than 70% owner. In France, if somebody has money, or in Italy or Spain or in Germany, he buy a property. In Switzerland, you have a lot of people, they have millions, but they rent, they don't buy. That means they are future buyer, maybe sometimes. That means you have a high unused, I would say, purchasing power for properties. Even the foreigner would not buy. You have Swiss, they could buy. That means the Swiss property market is very stable. Very, very stable, low tax, and it's just to keep the value. You will not make 10% a year, like maybe in Great Britain, in London the last 10 years. But you make a return on yields and on capital increase of maybe between 4 and 6%. On top location, it's maybe 3%, 3.5%, but compared to interest rates close at zero, it's very good. And you get mortgage below 1% interest rates in Switzerland. You get mortgage rates at 0.8. And you get 70% equity at 0.8. It makes you a huge return on your equity.
And is that for a fixed term, or what type?
No, this is not fixed, but I would not fix. I would not fix the interest rate, because if you look in Europe, in the United States, in the West, we have an environment, there is no strong economic growth for the next 5 years or even 10 years. We could have a situation like Japan. Japan, the last 20 years, that is something we could have this in Europe, because the population gets older. We have a competition problem with the globalization. That means the companies, they cannot increase the prices. We have no price power in Europe, even in the United States. And this situation is for the next 5-10 years. There's no way to increase the interest rates. If you increase the interest rate, you kill the economy, and you increase the budget deficits for the states. That means I would not fix in a mortgage rates for 10 years. You can do that. You can have in Switzerland a mortgage rate 10 years at 1.6%. There's nothing, 1.6. But if you don't fix it, you pay 0.8 or less. Why to fix something if there is no reason why the interest rates should go up? And if Europe cannot solve their problem in the next 5 years, they need more than 10 years. Countries with debts are very high in Spain, very high in Ireland, very high in Italy. You cannot just say, okay, and now the debts are gone. Forget it, you need 10 years to solve this problem, minimum, maybe more, maybe 20 years. That means we have an environment for the next 10 years, low growth, low interest rates. It's exactly good environment for stocks with high yields, not banks, stocks with high yields, dividends, high dividends, and for real estates on good location in countries with a stable political and tax environment. And the tax environment is good in Switzerland.